You know, when we stand before a chart, we aren't just looking at prices. We're watching the footprints of the composite operators as they move through a campaign. And today, I want to walk you through one of the most understated yet powerful ideas in tape reading, the no demand, no supply approach to timing trend entries. Before we dive too far, let me briefly link this to something many of you asked about after the previous video on why most breakouts fail and how to spot real ones, because this idea flows naturally from that discussion of effort versus result. Now, let's begin simply. In every trend, up or down, the great operators must constantly test the market. They must ask, is there anyone left on the other side who can stop me? And that's exactly what these no demand and no supply bars reveal. We're not predicting, we're observing tests, and we're deciding whether the market is showing strength or weakness in the most honest way possible, by its own behavior. Ask yourself, isn't it better to follow the market's intention than your own opinion? In an uptrend, the professional interest wants higher prices, but they won't push if too many sellers remain. So they test. They nudge price upward with very low effort, low volume, a narrow spread, a close off the high. If, on that bar, no one steps forward with meaningful supply, the trend is likely ready to continue. That's your no supply condition. It's not dramatic, it's quiet, but it is purposeful. And I'd ask you, how often do you ignore the quiet signs while waiting for the loud, exciting ones that everyone chases? Conversely, in a downtrend, they test the buying interest in the same way. A slight lift on low volume, a narrow spread, a close off the high. If no real demand appears, the downtrend is ready to resume. And again, notice how calm the test is. Operators do not shout their intentions, they whisper them. The crowd always reacts to noise, but the composite operator trades from silence. As a trader striving for mastery, are you training your ear to hear that silence? This whole approach depends on one crucial belief, that the market will reveal its true condition if you know what to look for. You aren't hoping for certainty. You are aligning yourself with probability, logic, and the path of least resistance. And that's the foundation of wealth building in speculation, acting when conditions favor you, not when emotions tempt you. Now, as we move deeper, remember something important. Earlier in the discussion around why most breakouts fail and how to spot real ones, we saw that false moves often come from uninformed traders piling in on excitement, while professionals take the opposite side. The no demand, no supply concept is simply another way of verifying whether those professionals are still active. It's another reading of the same tape, from a slightly different angle. Let's look closer. You'll often see no supply bars appear after a brief reaction in an uptrend. The price dips, volume dries up, and then you spot a small up bar with barely any effort behind it. That's the test, if the next bar confirms it. Perhaps by closing higher on increasing activity, you have a logical place to join the campaign. You're not predicting the entire future. You're stepping in where the composite operator has shown willingness to proceed. Would you rather guess where the trend continues, or read the evidence that the strongest hands are still in control? It requires patience, of course. Many traders grow uneasy when the market quiets down. They feel as though they should be doing something. But professionalism in trading isn't about constant action. It's about precise action. Quiet zones are information, rich for those who know how to interpret them. Do you treat low volume pauses as clues or as boring, unimportant stretches of time? And that's where mindset blends with technique. A trader who fears missing out will overtrade these pauses and get caught on the wrong side of the next move. But a trader who understands the purpose of testing, who sees no demand and no supply bars as information, not temptation, develops a calmer, wealth-building temperament. You begin to accept that your role is not to force opportunity, but to recognize it. Isn't that the mindset we all wish we had learned earlier? In addition, no demand and no supply bars give you anchor points, logical points of risk placement. If you're entering on a confirmed no supply bar in an uptrend, your risk sits beneath the test. Clear, simple, rational. This is how a trader stays grounded. Wealth grows not from the size of our ambitions, but from the consistency of our discipline. When risk is defined, decision-making becomes easier. Are you defining your risk that clearly today? Now, think about the relationship between these tests and overall market phases. In accumulation, no supply signals show that sellers have been worn out. In a markup, they show that temporary reactions are merely pauses. In distribution, no demand bars hint that buyers are no longer supporting prices. And in markdown, they confirm the path of least resistance is still down. This is not magic. It's the natural cycle of supply and demand playing out in real time. But are you reading the cycle or reacting to it? What I want you to notice is how all of this ties back to understanding the intentions of larger players. No demand and no supply are expressions of absence. The absence of interest. That absence matters more than most traders realize. A bar with almost no volume at a critical point can tell you more about future direction than a dramatic breakout bar ever will. Remember how we said breakouts often deceive? Well, tests rarely do. They carry no excitement, no emotional bait. They're pure information. And once you begin to base your entries on these quiet confirmations, you start trading less from impulse and more from alignment. Alignment with the trend. Alignment with professional activity. Alignment with the logic of supply and demand. And that alignment is where confidence comes from. Not bravado, not hope, not predictions, but a calm understanding of what the market is actually saying right now. You can ask yourself, at any moment, am I acting from alignment or from anxiety? When you adopt this way of reading the market, wealth building becomes a byproduct of good decisions, not a hunt for dramatic wins. You stop chasing the market and start waiting for it to give you permission. No demand and no supply bars are forms of permission. They are quiet nods from the market that say, the path is clear. If you wish to step in, now is the time. But will you slow down enough to notice them? And so, as we continue forward, you'll want to train your eye to spot these conditions automatically. The narrow spread, the low volume, the location within the trend, the confirmation that follows. This isn't complicated, it's observational. When we talk about no demand and no supply bars, we're really talking about something far more subtle than the usual trading signals people chase. Most traders get hypnotized by dramatic moves. Big candles, big volume, big headlines. But if you've studied how the market truly operates, you begin to realize that the most revealing information appears not in the noise, but in the quiet. A no demand or no supply bar is exactly that kind of quiet signal. It reveals the market's willingness, or unwillingness, to continue the prevailing trend, and the beauty of this concept is that it helps you read the story beneath the surface rather than reacting to the emotional reactions of the crowd. Think about an uptrend for a moment. Price has been moving higher, demand has been showing itself, and the path of least resistance is upward. But trends don't move in straight lines. They pause, they correct, they dance a little to shake out the impatient traders. The question a professional trader must ask during that pause is simply, is the trend still healthy? And that is where the no supply bar comes in. When the market pulls back and then prints a bar with a narrow spread and notably low volume, closing somewhere near the high, it tells you something powerful. The sellers are gone, or at least they're too weak to matter. The composite operator, who is guiding the campaign, is testing the market to see if supply still lurks beneath the surface. This test is not meant to produce an immediate reaction. Its purpose is to gather information, and that information is priceless to the trained eye. When volume dries up, it means the selling pressure that could threaten a continuation of the trend simply isn't there. If the next bar confirms the move by closing up with increasing activity, the test is validated. The uptrend is ready to continue. Notice that nothing about this process involves prediction. You're not trying to anticipate the future with guesswork. You're reading the market's current condition through the most objective data. It offers price and volume. Now consider the opposite scenario in a downtrend. Price is moving lower, supply is in control, and the path of least resistance is downward. As with any trend, there will be rallies. The question becomes, is this rally genuine buying, or just a temporary pause before the next move down? A no demand bar answers that question. when price pushes upward on low volume, forming a narrow spread and closing off the top, it signals that buyers are not stepping in with strength. The professionals test the upside by lifting prices slightly. If no meaningful demand appears, the downtrend is likely to resume. Again, the confirmation comes from what follows. If the next bar turns down on increased volume, the test is validated and the trend is intact. What makes these signals so valuable is not that they predict dramatic moves, but that they help you align with the underlying intention of the smart money. The composite operator doesn't reveal their hand during explosive moves. That's when the public is most active and emotional. Instead, they reveal themselves during calm tests, when they quietly check whether the opposing side has any strength left. When they see no obstacle, they continue the campaign. When you learn to recognize these moments, you stop reacting to the market's theatrics and start responding to its structure. The idea that no demand and no supply bars show the market's willingness, or unwillingness, to continue a trend is grounded in simple logic. A trend needs fuel. An uptrend requires demand, a downtrend requires supply. When that fuel disappears, the trend weakens. When it reappears, the trend strengthens. These bars give you a direct view into whether that fuel is present or absent. They reveal whether the professionals see clear air ahead or if they sense resistance that must be absorbed. Another important aspect is the psychological shift these bars offer. They teach you to listen to the market instead of your impulses. When you start paying attention to the presence or absence of volume at key moments, you naturally become more patient. You begin to wait for the market to show you its hand. You stop feeling the need to jump into every move. You become a trader who acts with intention instead of reacting out of fear or excitement. This is one of the most transformational shifts a trader can make, and it directly influences long-term wealth building. A calm trader who waits for confirmation is far more likely to grow capital steadily than one who chases after every surge. There is also a tactical benefit. These bars give you logical points of entry and risk definition. If you enter after a confirmed test, your risk can sit just beyond the bar's range. This makes your position more controlled and your decisions more grounded. When risk is clear, confidence follows. Not reckless confidence, but the quiet confidence built on reading the structure of the market as it is, not as you hope it to be. In the end, no demand and no supply bars are not magic signals. They are reflections of the market's internal balance. They show when pressure is drying up, when the trend is ready to continue, and when the professionals are quietly preparing for the next phase of their campaign. They invite you to look beyond the surface and into the intention behind price movement. And, as you begin to recognize their rhythm, you'll notice the market speaking to you in ways that most traders will never hear, simply because they're too busy watching the loud moves and ignoring the quiet ones. When traders first hear that true tests in the market often appear as narrow, spread bars with noticeably low volume, they sometimes underestimate how revealing such a simple pattern can be. But if you've spent time watching the behavior of the composite operator, the large, informed interests who guide campaigns, you begin to understand why these small, quiet bars often speak louder than the dramatic ones. A test is not a declaration, it is a question the market is asking. It is a probe, a gentle push, designed to uncover whether opposing pressure still exists. And because of this intentional subtlety, the bar naturally takes on a narrow spread and low volume. Anything more dramatic would defeat the purpose of the test. In an uptrend, for example, professionals don't want to push price aggressively every moment of the campaign. That would expose their intention and invite competition. Instead, they periodically pause and check the condition of supply. They lift the price just slightly, producing a narrow spread. They keep their activity minimal, resulting in low volume. If sellers jump in vigorously, the bar won't remain narrow and quiet, it will expand, and volume will swell. But if the bar stays small, controlled, and quiet, it means sellers aren't interested. That absence tells the professionals they can safely continue the markup. The key is that the professionals intend for the bar to be quiet, because they want to see whether the other side reacts. The true test appears only when the other side, does not react. Now imagine the downtrend. Price has been making lower lows, and supply is in control. If the composite operator wants to check for demand, they won't stage a dramatic rally. Instead, they will allow or gently encourage a slight lift in price. This creates the narrow spread. They will do so with light effort, keeping the volume low. The idea is simple. If buyers are still strong, they will reveal themselves even during a quiet lift. They will push price farther than the professionals intended, expanding the spread and increasing volume. But if the bar remains narrow with low activity, demand is weak. That quiet bar becomes a confirmation that the downtrend still has room to continue its natural course. Again, the bar's structure, its small range and its minimal activity, is not random. It is the result of deliberate testing. What makes these bars so fascinating is how counterintuitive they appear to inexperienced traders. Newer traders tend to focus on high volume and wide spreads as signs of strength or weakness. They often miss the more subtle clues because they are waiting for the market to shout. But the composite operator rarely shouts. They work in the spaces others ignore. A narrow spread, low volume bar might look insignificant to the casual observer, but to someone trained in the logic of supply and demand, it becomes a critical piece of information. It's a calibration point that tells you whether the trend is likely to resume without significant resistance. Another important detail is the timing of these tests. The same narrow spread, low volume bar means little if it appears randomly in the middle of a chaotic consolidation, but when it appears after a reaction in a trend, after the market has pulled back or rallied slightly, it becomes meaningful. The context gives it weight. In an uptrend, the reaction down creates the setup, the test bar provides the clue, the next bar offers confirmation. Each part works together. Without the narrow spread and low volume, the test would not be a test. It would simply be another bar. Without the context, the test would lose its precision. And because these tests are so quiet, they naturally connect to the trader's mindset. When you start appreciating these subtle bars, you begin to shift away from impulsive behavior. Instead of chasing big moves, you start watching the quiet moments. You wait for the market to reveal whether the opposing side is still active. You begin trading more from observation than from emotion. This shift can be one of the most powerful psychological evolutions a trader experiences. It teaches patience, trust in structure, and respect for the logic of cause and effect. There is also something deeply practical about focusing on narrow spread, low volume tests. These bars often give you cleaner, more predictable entry areas. Because the bar is small, your risk is naturally tighter when using the bar's range as a reference. This can improve your reward to risk profile without forcing you to hunt for unrealistic targets. The market becomes more cooperative because you're no longer trying to force yourself into high-energy moments. Instead, you're stepping in where the professionals have already cleared the path. One of the reasons these quiet tests work so consistently is that they reveal something more reliable than price direction. They reveal participation, or the lack of it. Price can move in many ways, but it cannot move sustainably without energy behind it. A narrow bar with low volume is the closest thing to a market whisper, a hint that the participants who matter are not fighting back. It tells you that the next push is likely to face little resistance, not because you predicted it, but because the market showed its hand first. As you watch more charts and study more campaigns, you'll notice that these narrow spread, low volume bars often appear right before the market makes a clean continuation move. They act as pre-movement checks, almost like a deep breath before the next step. The composite operator uses them repeatedly, quietly, methodically, because they provide clarity without attracting attention. And once you train yourself to recognize them, you'll begin noticing how often they appear right before the rest of the crowd gets excited, how often they mark the true resumption of a trend, rather than the emotional noise of the crowd. When you understand that no supply signals strength in an uptrend and no demand signals weakness in a downtrend, you start to see the market through a completely different lens. You're no longer just watching prices jump around. You're watching the underlying struggle between buying and selling pressure, and more importantly, You're watching what isn't happening. Most traders focus on what the chart is doing, how fast it's rising, how far it's falling. But the trained eye focuses just as much on what the chart refuses to do. And that difference is where the real edge begins. In an uptrend, the market is being lifted by demand. Buyers are willing to absorb whatever supply appears, and they keep the trend moving higher. But even in a healthy uptrend, there are natural corrective phases, pullbacks that test whether sellers still have the power to interfere. The key moment comes when the market stops pulling back and begins to show that supply has dried up. That's where the no-supply bar reveals itself. A small, narrow, spread bar appearing after a reaction, accompanied by noticeably low volume, tells you that the market tried to drift down, but couldn't find meaningful selling pressure. And that simple lack of supply is what strengthens the uptrend. Think about it: if sellers had strength left, volume would increase as price dipped. But when price dips quietly and barely moves, it shows that the sellers may have already spent their ammunition. This is why a no-supply bar is not just a passive observation. It is a direct message about the internal condition of the market. The composite operator, the informed interests who control the majority of volume, do not want to push prices aggressively unless they're certain the path is clear. So they step back and let the market drift for a moment. If no sellers appear, the bar remains quiet. If sellers stay silent, demand can step in again and lift the trend higher. A no-supply bar is strength not because of what it does, but because of what it reveals: the absence of selling pressure that could interrupt the campaign. Now look at the opposite scenario in a downtrend. A market that is trending down is being pressed by supply. Sellers overwhelm buyers, and every rally is simply another opportunity for more selling to appear. But just like in an uptrend, these downward moves are interrupted occasionally by minor rallies, small attempts by buyers to test their luck. During these rallies, the professional side wants to know whether demand is strong enough to create a real reversal, or whether it's just a temporary lift before the next leg down. This is where the no-demand bar comes into play. When the market rallies slightly and prints a small bar with low volume that closes off the high, it whispers something important. Buyers aren't committed. They aren't showing strength. The rally lacks real demand, and without demand, the downtrend remains intact. A no-demand bar is weakness not because the bar itself is dramatic, but because it reveals the absence of buying interest. If buyers were strong, the rally would expand on rising volume. But when the bar shows a narrow spread and barely any activity, it tells you that buyers aren't eager to support higher prices. And without that support, the trend is free to continue downward as soon as supply steps back in. Just as the no-supply bar confirms the strength of an uptrend, the no-demand bar confirms the fragility of a rally in a downtrend. What makes these concepts so powerful is how they help you avoid the emotional traps that catch most traders. Many traders try to buy dips in downtrends or sell rallies in uptrends simply because price looks cheap or expensive. But price alone doesn't tell the truth. The presence or absence of demand or supply does. When you anchor your decisions to volume behavior, you begin to see that not all pullbacks in an uptrend are dangerous, and not all rallies in a downtrend are opportunities. Some are simply pauses, but others reveal real pressure returning. A no-supply or no-demand bar helps you distinguish between the two. There is also a deeply practical component here, because these bars act like checkpoints in a trend. A no-supply bar often appears just before a continuation of an uptrend. A no-demand bar often appears just before a continuation of a downtrend. You're not catching the exact bottom or top, but you're stepping in right when the market is quietly signaling that the path of least resistance is about to resume. These are moments when the market shows you its intention through the simplicity of low-volume tests. And as you grow familiar with these conditions, you begin to internalize a much healthier mindset about trading. You stop feeling the need to predict every turn. Instead, you start observing how the market behaves when it encounters potential resistance. You look for signs of strength in an uptrend, not in the big green candles, but in the absence of supply. You look for signs of weakness in a downtrend, not in the big red bars but in the absence of demand. This shift naturally makes you more patient, more rational, and more willing to wait for the market to show you real evidence. When traders talk about the importance of aligning with the trend, this is what they mean. It isn't enough to recognize that the market is moving up or down. You need to confirm that the pressure driving the trend is still alive. That confirmation comes from seeing whether supply or demand appears at the most critical moments. If it doesn't appear, the trend is still supported. If it does appear, something in the structure may be changing. No supply bars tell you the uptrend has room to keep moving. No demand bars tell you the downtrend still holds the upper hand. The clarity in these small, quiet signals is what allows you to approach the market with more structure, more discipline, and ultimately, more confidence in the trades you choose to take. Professional operators use tests like no demand and no supply bars to gauge whether the opposing pressure has dried up, and the more you understand this dynamic, the more clearly you'll see what's actually happening behind the scenes of every trend. Most traders imagine that the big money pushes price in one direction non-stop, as if trends are just the result of relentless force. But in reality, trends are built through a rhythm of action, pause, and verification. Professionals do not move blindly. They advance when the path is clear, and they pause when they need information. That pause, subtle, quiet, sometimes barely noticeable, is where a test appears. Picture a strong uptrend for a moment. Price has rallied, enthusiasm is building, and the chart looks supportive. But the professionals, the composite operator, are not satisfied with appearance alone. They want to know whether anyone is still willing to sell into this strength. If too much supply remains, forcing the market higher would require unnecessary effort. So instead of driving price aggressively, they let the market rest. They lighten their activity deliberately. The bar that forms during this moment of quiet is the test. If it prints with low volume and a narrow spread, it tells you something crucial: sellers aren't eager. Supply is drying up. The uptrend is safe to continue. This is why professional traders rely on these tests. They don't want to push into resistance blindly. They want to confirm that the crowd has no strength left to oppose the move. Think of it like a general nudging a door to see if anyone is leaning on the other side before ordering troops forward. A light push tells you everything you need to know. If the door moves easily, the path is clear. If there's resistance, you regroup. The market works the same way. A no-supply test in an uptrend is the door swinging open without effort. In a downtrend, the logic reverses, but the principle stays the same. Price falls because supply dominates. But as the market dips and the crowd becomes fearful, occasional rallies pop up. To the inexperienced trader, these rallies can look like reversals. But the professionals don't assume anything. They lift price gently, creating a low volume, narrow spread bar. They are checking for demand. If buyers are strong, they'll reveal themselves even during the lightest rally. They will increase volume and widen the spread, but when the bar remains small and quiet, closing off the highs, it tells the informed trader exactly what they need to know: buyers are weak. Demand has dried up. The downtrend can safely continue. This quiet probing is the heart of professional strategy. The composite operator isn't looking for big, dramatic clues. They're looking for silence. Silence from the opposing side. That silence is the cleanest, most honest signal the market can give. A no-supply bar whispers that sellers have stepped aside. A no-demand bar whispers that buyers have little interest. When you see these whispers, you're seeing the reality behind the price movement, not just the surface behavior. And because these tests require almost no energy from the professionals, they are elegant tools. If they were to test with large volume or wide spreads, they wouldn't be testing at all. They would be influencing the market too heavily. The point of the test is to observe, not to create an artificial reaction. This is why the low volume nature of these bars is essential. It ensures that whatever reaction occurs, or doesn't occur, is genuine. If the market responds strongly despite the lack of professional effort, the test fails and pressure remains. If the market doesn't respond, the test passes and the path is clear. It's important to recognize how different this is from how most retail traders operate. Many traders make decisions based on emotional reactions to price movement. They enter because they fear missing out or exit because they're afraid of losing gains. Very few traders pause and test the market the way professionals do. Very few ask themselves, is there really any pressure left opposing the trend? Instead, they rely on indicators, predictions, or hunches. But professionals don't need predictions. They rely on information. Tests give them the information needed to continue a campaign with confidence. Once you start thinking in this way, your whole mindset shifts. You stop trying to guess the future and start trying to understand the present. You begin to focus less on where price is going and more on whether the opposing side is strong or weak. When sellers disappear in an uptrend, price will naturally rise without resistance. When buyers disappear in a downtrend, price will naturally fall. These patterns don't rely on hope or prediction. They rely on objective observation. This approach also helps you build discipline. A trader who waits for confirmation of dried up pressure becomes more patient, more selective, and more aligned with the natural flow of the market. Instead of jumping into every movement, you wait for the professional signal, the quiet moment when the opposing side shows no interest. Those are the trades with the highest probability of following through, not because they are guaranteed, but because they are supported by the underlying mechanics of supply and demand. There's a certain calmness that comes with trading this way. You aren't getting swept up in the noise. You aren't chasing breakouts or reacting to dramatic candles. You're watching the places where the smart money pauses, listening for whether the other side is still active. And when you see that the opposition has faded, you step into the trend with clarity. Understanding why professionals use these tests gives you a window into how trends truly operate. They don't continue because of excitement or momentum alone. They continue because the pressure required to move in the opposite direction has diminished. A no demand or no supply bar isn't just a chart pattern. It's a reading of the market's internal health. And once you start to trust that reading, you will see trends in a way most traders never will.